Live where you want, invest where the numbers make sense.
Today, I'm here with Lane Kawaoka, who's going to be chatting about his journey towards $2 billion in real estate acquisitions and over 10,000 units.
I made a pretty good salary and was able to save 30, 40 grand per year right out of college. And after a couple of years, was able to save up 80 grand. That was when everything changed. Never listen to a multifamily guru who's trying to sell you a $50,000 program, because they'll always tell you that you're amazing and you can do it. A lot of the general partners that were around when I started, they're out of business. At the end of the day, it's not what you're going to do to it necessarily, like what you paid for the damn thing. And right now, the basis is low. From that perspective, it's a great time to get started.
We have a lot of value in store for you guys today. Lane, thank you for your time today.
Hey, thanks for having me, Vince. Aloha, everybody.
So you are in Hawaii, is that right?
That is correct. Live where you want, invest where the numbers make sense. Right?
Oh, I love that. So you've kind of picked where you want your lifestyle to be, and then you're designing your real estate, investing in business around that. And I think a lot of people think they need to chase this never ending goal, of this big passive income number before they live where they want to be.
Yeah. But sure. I mean, we'll get into it. But I mean, prior to hitting $1 billion of acquisitions, I mean, I was, up on the mainland, closer to these deals, a lot more hands-on. So
we're certainly going to dive into your real estate journey and really unpack that. But before that, so people could get a little bit of a foundation of where you were before, could you walk us through what things were like when you were growing up? Where did you live? What were the conversations like around money? And what did college look like for you in terms of what you studied, where you went to school? That just helps us get a really nice framework of, what you were exposed to before you got into real estate investing.
Yeah, so my parents always taught me to study hard because they went to, master's, doctor degrees. I mean, we weren't wealthy by any means, but, that was the path that worked for them. And that was kind of what was shoved down my throat. And I was on this roller coaster of a linear path where you're taught to study hard, go to school, and then get a white collar job. I became an engineer, just kind of following that line because I didn't want to go to more schooling. I just wanted to get out in the workforce and make money. But as far as like growing up, I mean, just a couple of examples. When we go to a restaurant, rarely did we go. We never buy soft drinks. That's just a waste of money. Get freaking water. And if it is the other thing, I'm noticing I got kids these days, so it's all the things I don't. We go to restaurants all the time. That kind of stuff. My parents never rented their properties, never had any rental properties. They actually discouraged it when I was like 9. I asked my parents like, hey, like, do we own our own house? And they're like, yeah, but you shouldn't say that because, that's bragging. Not everybody owns their own house. And then, I'm kind of a questioner personality. So I was asking like, well, what do people do if they don't own their own house? And they said like they rent it. I'm like, okay, well, we should rent our house and make some money. And they're like, no, don't do that. They'll screw up your property. And that was it.
So
right?
funny.
I think I was like 8 or 9 back then. Never came across the idea again. But that was, never had any rich uncles. I didn't even know what a credit investor was.
And so then where did you end up going for college and what did you study?
Yeah, University of Washington, Pacific Northwest, became an engineer, did industrial engineering, and then I got a master's in civil and just started to go work for the man. Was not a very good engineer, so I went more into construction management and started to work for the railroad and started to travel 100% for work. So I was really never home. But
And
I
think,
I made a
oh, sorry, go ahead.
I made a pretty good salary and was able to save 30, 40 grand per year right out of college. And, after a couple of years, was able to save up 80 grand, 20% down payment on a nice house to live in Seattle. And again, following this linear path of invest in the 401k, buy a house to live in, kind of on a whim, I just was, I was never home. I was only home on Saturday because my job took me, I got home late on Friday night and had to leave Sunday afternoon, catch a flight from Seattle to Denver to go wherever, Wyoming, Texas. And, I was in my early 20s at the time, single, didn't have any kids. And I was like, well, let me just rent this thing out. And that was when everything changed. That was where I got this taste of cash flow, and I was like, "Whoa, what is this?" I mean, at first it was cool because it was a little bit of beer money, but then I realized like, "Wow, this is my ticket out of the rat race."
If you don't mind sharing, I mean, it's behind you now, but what kind of income were you making when you had these jobs? Like, what were you starting off at? Where did you kind of end up at? So that we could just have an idea of, okay, you were saving 30 to 40K a year based on what income. And then it gives us an idea of what you had to replace through real estate, which I think could be interesting for a lot of people if they're in a similar income band today.
Yeah, this is back in 2007. I graduated, so it was under 100 grand. Let's just call it 80 or 90. But the one cool thing is even when I was, didn't have the rental income, an extra 20, 30 grand a year from the first rental property, I mean, I was super cheap and I was on expenses 100% of the time. Like there'd be months where I would only spend $100 of my own personal money, because
Wow.
before I would come back home on the weekend, I would like hit up the Indian casino buffet, stuff myself, and then I would just intermittent fast the entire Saturday. And on Sunday it would hit the road again, right? Like the only thing I would spend money on was like literally my bar tab,
Oh
not
my
personal
gosh.
expenses.
I've never heard a story like that. That
So
is crazy.
yeah, so before I had the rental property, and when I was home a lot more, I was saving maybe 30, 40 grand a year. But then when
Okay.
I went, like when I kind of was homeless, right? Which I always think is kind of a lame story, but I guess technically I can homeless, right? But I was saving like almost like, yeah, like call it 90, 100 grand every year.
S-
And that was
s-
really what turbocharged me from 2010 to 2015. I kind of lived like that lifestyle.
So you were just obsessed with savings and supercharging all of this money that you were saving. Were you putting all of it into the stock market, or did the real estate journey start to come into play here where, you were either actively or passively investing in some deals? If we could start to kind of look at, where that real estate journey started to go after that first property.
Yeah, the details are a little fuzzy, so maybe pardon me if it's not entirely
Hey,
correct, but
all those bar tabs, I'm sure it is a little
yeah,
fuzzy.
I mean, the stuff worked. I guess like a decade later, right? Like if you save that much money, you're gonna be fine. But
Yeah.
I do believe like 2012, I bought another duplex in Seattle. It wasn't much of an A class rental property; it was more of a B class. And then after that, 2014, 15, and beyond, I started to buy a bunch of rental properties. So I actually had five in Atlanta,
Oh,
four in
interesting.
Birmingham, and then one in Pennsylvania and in Indianapolis. So I had 11 rental properties by 2015. But I want to say that to do that, I know I didn't have any stock market stuff anymore.
Okay.
I probably withdrew the Roth IRA and the 401k stuff prior to that, like 2012 or 13, because I was like, why would I want to be in this roller coaster that makes 8 to 9% supposedly? Whereas, I mean, when you're making money in real estate, cash flow, tax, I'm sure you guys talk about this stuff all the time. I'm like, your multiples more than that. Um, I mean, later on,
Yeah.
I later realized that you should be more diversified. We can talk about more of that later. But like at this time, like my net worth is growing very greatly, mostly because of like just personal finance and budgeting. Because I was saving so much money every year and putting it into things that kind of was stable value.
So you were buying these properties, were they all single families and duplexes? And then I'm guessing you started to hit kind of a wall in terms of scalability. And you're like, I'm going to have to do something that's bigger or more
Y-
passive.
Yeah, I mean, for some people, like on the first floor of the wealth elevator of my book, we kind of categorize and cattle grade investors, right? Because based on where you're at, there's different strategies. But for people on the first floor of the wealth elevator, not yet a credit investor, $1 million net worth or lower, to me, the name of the game is buying single family homes because they're easier to just sell to a retail investor, or not a retail investor, but a retail owner. As opposed to duplex or quad, you might get a better cash flow, but the resale on that isn't as strong. So that's exactly kind of what I did. Right, I had a bunch of single family homes. They cash flowed very minorly, like maybe a few $100 a month, but with 11 of them, I had maybe a catastrophe every quarter, and then the big issue was an eviction or two every year, and then maybe I had like a half a dozen evictions, but one or two of those turned out to be huge repair bills because they just trashed the property, like talking like 5 or 20%. So that was kind of where the growing pains started to happen. It's like this is just, I mean, it's fine. I had a professional property manager to deal with it all, but all this headache just for a measly 3,000 a month or 30 grand a year, right? Like most of my clients today need $10,000 to $20,000 of cash flow. So you're going to need to multiply that number by 3 to 6 times exception rate. So now you're talking
Yeah.
like an eviction every other week, it seems like. um,
Yeah, I agree. There's some really good points here that are really firm beliefs. And the things that I'm not sure on, I'm always honest and I tell people, but because I've sold $50 million worth of real estate and I've seen these things play out for years, and I've read probably almost every real estate book there is, and I study history a lot, especially around economics and real estate, I can tell you for certain that a lot of people have this cheaper mindset around real estate that I do not think serves them long term, where they are maybe living in a medium cost of living market like Atlanta or like a similar city. And they look to cheaper markets where they go, I'm going to try and buy a property for 100K and I'm going to get 10 of them and hope that they cash flow at $200 a door and that it makes this passive income. I just don't think that that's a good strategy at all whatsoever. You don't have boots on the ground there. You don't live there. And like you're saying, oftentimes the tenant class is lower. So more evictions, more turnovers, more problems, and more wear and tear on the properties. And the gap for the cash flow is just not big enough. And then that's just not realistically going to give you the lifestyle that you want. You want to land in that range of $10,000 to $20,000 a month of cash flow. And there's variability based on how active or how passive it is. But I don't like that out of state investing strategy for just cheap C and D class rental properties. I just don't think it's a good strategy. Now, if you're getting short term rentals and you have one property that maybe cash flows $2,000 a month, that's a different story and it's a completely different approach. But I'm really interested in the path that you went down. So I want to start to go that direction. So how did you start to go from a few doors with out of state investing to 10,000 plus units? Was this all as an LP? Did you start to just invest all of your money passively into syndications and other people's deals? Or did you start to do deals on the GP side where you were actually the one doing these real estate deals?
yeah. So initially, yeah, I had these growing pains, right? And then I was just kind of just thinking all by myself in a vacuum, like, well, the single family stuff worked. Let me go to multifamily, right? Oh, that's an apartment. Okay, cool. Let's invest in apartments. And then this is back in 2016. So back then they had a lot of like gurus that would kind of teach this stuff, and then multifamily camps. And I I kind of was lucky because I wasn't married and I didn't have to ask anybody for permission. And then I had previously sold some good properties in Seattle, so I had some cash, right? So I kind of, whether it's a mistake or not, it's all part of the journey, I suppose. But I kind of blew some money on like a bunch of like silly coaching programs and guru programs, which got me in the door and around a lot of people doing deals back in 2016. Since then, a lot of these groups have imploded, right? But it's kind of interesting. Like you see a lot of like the bigger names come from these some of these camps these days. Um, but that was kind of where I the first step I was like, I don't want to be passive. And at the time I was still in my 30s and I was already an accredited investor. So I was like, well, if it just keeps growing on the same pace, right, I'll be able to quit my day job and, as an engineer. So I was like, well, I don't need to be a general partner. I just be a passive, right? But let me learn how to be a good passive instead of just like blindly looking at a silly pitch deck and taking whatever the projected returns. Like I want to be able to, like, what is the reversion cap rate? What are the actual rent increases? And this is viable, right? Um, I even took it a step further and like, checked other comps. Is this verifiable? Some of the stuff is verifiable. You look at the P&Ls, right? Like a lot of the stuff that, I was kind of going through the motions of being a general partner, talking to brokers, and they always, this is the kind of the nonsense they teach in these kind of things is like, learn how to analyze the deals, step one, right? So check the box there. But the next one is like, now talk to brokers and kiss their butt and try and get these deals and then, underwrite the deal and give them realistic feedback so they know that you're not a joker, right? Um, and I did that, and I learned a lot about underwriting properties, which obviously helped me then and helps me today. But I kind of fell back to a point where I'm like, yeah, I don't really want to, because a lot of these brokers, they know like a lot of new people are always in this business, and you got a property in Atlanta, and they want to see you, right? Because they want to know that you're serious, as opposed to just another bozo in California who's took a multifamily program, or worse, did some e-course,
Right.
and now just like putting some LOIs together from a distant shotgun style, right? And I was kind of like, yeah, I don't really need to do that. And I felt like I had some deal flow at the time, because when you're in these groups, everybody's doing deals. Your inbox fills up, but that was kind of my lesson learned. Is like, I didn't realize that a lot of those people were just like newbies, right? Like, and this is what we teach a lot of folks these days: is not only do you like, once you look in the numbers, right? But from an operator standpoint, I personally don't really want to invest with anybody under $1 billion of past deals, right? I mean, I certainly don't want to invest with
That's
like a
a
big
really,
institution.
really high ceiling. And you're talking about, so you tried, and I just want to get really specific here if we can. So you tried a little bit on the GP side. Did you just analyze some multifamily deals on the GP side, or did you actually acquire some and have them for a little bit and then offload them or keep them? Or like did you just learn quite a bit about it and then you were like, I don't want to do that, and
it
you just
it
start
all
plowing
kind
all
of
your
it
money
all
into
kind of
LP
happened
deals?
in like the same like few months. Like, my initial intention was just to be a passive investor, right?
Got it.
And then there were some opportunities to like sign on debt. And for people who don't know, like, the big chicken the egg thing on these apartments or any real estate deal is getting the debt assigned, right? Like, you have to have a loan guarantor team. I think key principal, KPs is like the acronym. That your group needs to be greater than or equal to the loan. And my net worth wasn't super high back then, but I kind of, everybody has it in their head that it's nice to have the Fannie Mae Freddie Mac card. It's not an official card, right? But once you're on one of these deals as a loan guarantor, it kind of makes you more valuable to a sponsorship team in the future. So I didn't know what I was going to do with this thing, but I just figured just do it, right? And it also got me kind of on the inside curtain of a lot of these deals very early on. But yeah, it was shotgun style, because I was selling off my single family homes at the time, and I needed to place capital, and to do the lazy 1031 exchange thing, right? Like, when I redeploy into these deals, I get the passive losses, the big bump that first year to offset the sale. So that's whether it was right or wrong. I see some mistakes now in that process, but I think like I went to like 15 deals pretty quickly, like,
On the
and
GP side, like, or with
no,
partners
just
on the GP side?
GP and LP side, yeah.
Okay. Do you know how many
But
of
then,
each you did?
no, I don't know, Vince.
Okay.
Dude,
Okay.
I don't remember. But the point is like, what I do remember is like at least a few of them were like with people. I'm like, oh shoot, I shouldn't have done that, because it's just a joker who's just faking it till they make it.
Oh my God.
Might have been a good deal, because I mean, I know how to, like, the nice thing about underwriting deals is it's kind of black and white. And that's what's nice about real estate, where nowadays we kind of do more private equity, and then just use angel investing as an example. Like, there's nothing to underwrite there. It's a wild gamble guess on that side of the world,
One in a
where that's
thousand.
what's nice about real estate. You can take the P&Ls, you can see where it's the income and expenses has been trending last 24 months, and you can kind of speculate like, well, if we infuse it with $10,000 of per unit, the rents are going to go this high and at this pace, right? That's another thing that these syndicators will kind of fudge, is how quickly they'll bump the rents up, and that type of stuff. But yeah, yeah, I kind of realized, and being on the inside curtain, I started to realize that a lot of these guys, I mean, I don't know, maybe people are going to be upset with me, but like a lot of people never, who were general partners, were just, they didn't have the professional pedigree. Like, they didn't have real
Mm.
jobs. A lot of them didn't go to college. I'm not saying that's important, but to me, at least if you're in your ages 30s and 40s, you should be at least to middle management at that stage of your professional career, as an indicator of past successes. Um, or you're a house flipper that flipped 100 houses by that point, right? Like, to me, it's one or the other. But what you started to see from a lot of these camps is you would just get a bunch of like 10xers who just like scrounged up, called their credit card, and paid for a $50,000 program to get in. And they had a lot of motivation because what else were they going to do? Work their crummy $40,000 a year day job?
So they really
Or
weren't qualified to be doing these deals on the GP side at all, but it attracted a lot of people that think that they can make a lot of money quickly and without really being qualified, no filter or bar that they had to clear to do it. And that sounds like it attracts a slightly different version of people that get attracted to wholesaling a lot of the time.
yeah, exactly, exactly. I think the other part is it's. I mean, I didn't know all this stuff when I first got started as an investor, passive investor myself. But in these, in the beginning world, like it's kind of a S show, right? Like in the beginning, like you have these huge general partnership teams, partly because nobody can get anything done and raise capital. But like you have 12 person general partnership, and you don't know who's doing what, and really the people running the show is, like I said, that very unsophisticated character with no track record, but they have some like rich guy who's some unsophisticated rich guy who they happen to trick to signing their debt along with them because they had some beers and they wanted to both grow. So it's really hard. It's hard. Like, I mean, this is what makes it hard for new passive investors, right? There's this charade of all these shadow games going on, and like when at first when I looked at it, it's like, wow, there's a big general partner. Oh, those guys are big shots. That guy's a big shot, but they had nothing to do with the deal, but still being in the general partnership. Um, and so I was in some of these deals myself, and admittedly, like I was kind of part of this too, right? Like, but I kind of saw who were the people who actually did anything, right? Because it's kind of funny, like when the deal closes, everybody's excited, but out of 12 people, only like 2 people may do actual work or add value to the town partnership.
Yeah,
Um,
that interesting. Okay, so you had to wade your way through a lot of crap, basically, is the way to put it. I want to talk about the deals that you have invested in. It sounds like more of your investing has been as an LP than as a GP. Is that right? And if so, can we talk a little bit about like some of the returns that you have seen or missed, or is there a range that you kind of look for? Because I'd be really interested to talk about like if it's been mostly multifamily or other asset classes, and how you kind of think about cash on cash returns, equity multiples, and IRR, and what you might kind of look for or expect in some different asset classes.
yeah, I mean, for the last maybe 5, 6 years, I typically have like 80 to 100 K1s come back with me. I don't know exactly how many deals I'm in, but the
Wow.
vast majority of that is general partner role because I would say after that initial 15, I was like, these guys aren't like, I think for me, like I maybe I have low self-esteem, but I started to realize like the people running the show were less competent than myself. And
Oh,
it's not like
interesting.
I don't call myself a control freak, but I'm like, I think I have a little bit more like, I mean, I'm a professional civil engineer project manager. Like this is what I do for a living, and project manage. Like real estate isn't the hardest thing in the world to do, right? So that's where I kind of got over that hump mentally, and I was like, well, let me just, if I'm gonna put all my money and eggs in this basket, I might as well just be part of the main general partnership team. So what ended up happening is like the people who actually did stuff, like we kind of knew who each other were, and we're like, let's just leave this bunch of degenerates behind. And yeah, like we started a good time, right? Like I can't really speak, because it's not really legal. People always talk about their past performance and stuff like that's not legal to talk about that because you're cherry picking what you're doing. That's not what the regulators like. But we let me just say, like we started at a good time, right? Like we got established, we started to do deals. I mean, I actually had one of the good deals in Atlanta where you're at in Decatur, right? But a lot of them were like junker class C properties in the beginning because that's all the brokers will give you when you're getting started. Um, like I mean, they're kind of a headache, right? Because the tenants barely pay rent, and when they say that, like you're gonna have 100% or 90% occupied property, but on those types of assets, like 80% collections is pretty damn good.
I'm
So
kind of curious, like, have all of the deals that you've done so far on the GP and LP side been multifamily? And if so, I would just have some interesting questions kind of on multifamily, but I'm curious if you had done anything else as well.
um I would say 90 something percent is
Okay,
multifamily.
so
Yeah.
mostly multifamily,
Yeah.
and so It sounds like you're on the GP side of multifamily deals in multiple markets. Um, has it been difficult for you guys to kind of set up operations and get property managers or boots on the ground and things like that in multiple places, or have you kind of developed these systems over time?
Yeah, I mean, people are in different camps with this, right? Whether you go in house and sound all cool, saying vertically integrated. I've always thought that third party is a better way to go because you can fire them when they don't do a good job. I mean, some of the things I've seen from my side over the last 5 years is if a property management company is not performing, but a partner in it, like you can't really get rid of them, right? You can get rid of them, but now they just you kind of made their job easy for them. They get free equity that way because you
Yeah,
made them part of the general partnership. And then
interesting.
the other thing that I think a lot of people don't realize is like when you look at the fee schedule for a lot of these deals, typically for if you can do the work in house, that's an extra revenue stream for the general partnership. They get like an extra 10% on all the work performed. So that's why they like to do this vertical integrated nonsense. And I see like, I mean, there are some like, it's not super transparent on what is all happening. Whereas, just like how you get third party books or third party accounting, right? Like for good reason. Like I think third party property management company is nice too, right? But I think the biggest thing is you can interchange them out. But what I think what you're kind of getting at, like what we started to do is we started to cluster our properties in a handful of areas, right? Like Huntsville, for example. I mean, the key is to get it over 1,000 units because once you're above that level, you can actually talk to the owner of the property management firm, and there's different levels of property management firms. Right, you have the big, huge guys who have like 50,000 units, right? Like a Hawthorne, right? Like, I mean, great company, right? But they're the bigger guys, and you're not going to be able to have the cell phone of the guy, right? To make actually if something needs to get changed. What we found that works best is working more like the regional property managers, not that really the small mom and paws. We've had some not best success with the smaller guys. So some people do. Some people do have, they find a good guy and they kind of grow with them, but it doesn't work out most of the time, right? So it's obviously a gamble. But if you can find a regional company that has maybe 5,000, 20,000, I guess that maybe that's kind of getting high, right? But 10,000 units, that's actually I think the nice sweet spot. So if you yourself can get to 1,000 or a couple thousand units, we're talking you're like a, a tenth of it or 20% of it. Like you're a sizable customer, so you should be able to have some pull some weight, right? That's the key.
This episode is brought to you by Easy Street Capital, the lender built by investors for investors. Whether you're flipping, building a rental portfolio, or executing a ground up construction project, Easy Street has 3 nationwide loan programs designed to close fast with no surprises. We're talking 24-hour closings, upfront terms, and in-house servicing from start to finish. If you're ready to fund your next deal, go to easystreetcap.com/launch REI to get started, or you can grab the link in the show notes. Most real estate investors I know are overpaying in taxes simply because their CPA is reactive, not proactive. That's why we recommend TrueBooks CPA. They specialize in year-round tax planning for real estate investors, depreciation, cost segregation, entity structuring, and their clients are always surprised by what they were leaving behind. Do yourself a favor and find out what you're missing. Go to the link in the show notes and book a call with them. Are you looking for a certain level of cash flow or profit per unit? I'm just kind of curious if you have like a rule of thumb that you look for, like, hey, we're going to allocate these percentages to these expenses, or we know that operating expenses are going to run at about this. And, we're expecting or wanting at least X amount per unit profit after the debt servicing and all the expenses. I was just curious if there's any kind of like rules of thumb or, really firm kind of metrics that you try and stick to among the deals that have worked out well for you guys.
Well, I mean, back in the day, like prior to 2022, I mean, you try to look for deals that cash flow 6 to 8% at least. But then that's not possible. It's not, I mean, the world has changed after 2022.
It's
Um,
just gotten a lot tighter, and the margins are just
yeah,
not
yeah.
quite there on a lot of
So
these.
I mean, we do that some of the times. Like we go into more tertiary markets with this particular strategy of going for more cash flow because the tertiary markets in this day, this may change in 18 months for all I know, but the tertiary markets, yeah, you don't have the nice growth in rent growth like you would in Phoenix, where it goes up 5%, 20%, apparently in 2021. But it's more steady and it's more cash flow based. And right now, like a lot of those tertiary markets and smaller secondary markets, you don't have the huge overgrowth of new supply hitting the market. Like right now,
Got
like
it.
if you see a deal in Phoenix, um, underwrote with any type of rent growth in the next year, like you got to be kidding me, dude. Like that's not like I would just throw that out. I mean, we see that all the time. Phoenix and Austin, that you still got negative rent growth there. You know,
Yeah, that is definitely a consideration, and your assumptions that you write in around rent growth can kind of make or break a deal too. Like, especially if the numbers are tight, I'm sure. Um, so let's
I'll
talk
tell
a
you. I'll
little.
tell you what.
Yeah.
Like getting back to your earlier question, like what I like to look for is like it's you're not going to get it with cash flow, right? Because in the beginning, in 2016, like maybe half of your returns would come through cash flow, and then slowly over time, cash flow came less. So like 1/3 was cash flow and 2/3 was the pop at the end, right? When you finally sell
Oh,
it
interesting.
after you do the value add. Nowadays, I mean, it's kind of similar, if maybe even worse. So like the way the water line to me, just on paper, right? Like when you underwrite the deal, is if you're not getting like a 2x equity multiplier in 5 years conservatively, then I just kind of pass, right? But the key is like, I mean, anybody can show a property doubling their money in 5 years. You just change the reversion cap rate and you bump it up by or lower it by 0.5%, and you're there, right?
Mm,
But the key is, and this is kind of where I've kind of emulated like the next level of investors out there, what a family office will do, right? What do these guys do? Well, they hire professional underwriters. They have people looking for deals for them, and then they take in all this raw data from these deals. They don't even look at the pitch deck and the underwriting. Like it'd be nice. It kind of speeds up the process, yes, but they apply their set of assumptions, right? Like I don't want to see. I mean, like Oklahoma City, I don't want to see more than 1.5% rent escalators in there every single year. I don't want to see a reversion cap rate of lower than this, right? Um, and maybe there's like we could probably go maybe half a dozen things if you want to go in more detail, but um, I want to use these presets and I want to underwrite the deal kind of making apples to apples, because that's the problem as a passive investor. You get all these deals sent to you, but everybody's BSing and lying on all the assumptions to get to that number.
yeah, I've certainly heard that a lot. So I'm not surprised that you've kind of encountered the same thing. I'd like to talk a little bit about tax strategy for high income professionals. I know that you have some thoughts to share on that. So we could cover some of the high level around depreciation, cost segregation, bonus depreciation, some of the basics. If people are kind of hearing about these, or they're not sure how and when they might apply or get to use some of these things.
Yeah, I mean, I'm not a CPA, but I mean, I'm sure you guys have talked to this in the past, how great real estate is with taxes, and it is. But I'll just throw in a couple anti caveats to this whole thing. I mean, if you're not a real estate professional status, like and you're not able to employ the rep strategy, which most investors are not, right? Like a lot of people, they may have one high income earner, and then the spouse doesn't have a day job, but the spouse doesn't want to do anything in this business, right? You can't do reps. So all the passive losses you get from the depreciation is, remember, passive, which can be used to offset passive income, where you can't do a damn thing to offset the ordinary income. Again, you need reps to do that. People need a referral to a CPA who understands this stuff and can kind of walk you through it. Let me know. But I think that's a huge misnomer. Um, that said, the idea is long term is to turn most of your income from that dirty ordinary income color to passive income, so the passive losses can offset your passive income. Um, but for a lot of people getting started, you're very tilted to the ordinary income side, and um, so the only other thing to do, I mean, people used to do like things like land conservation easements, which kind of went away. Too much audit risk there, but oil and gas is another option out there that we kind of do. um, People are interested, we can talk more about that, but um, yeah, like real estate is not going to cure your tax problem per se, especially if you're not doing rep status. So I think there's a big miss. I just see it from our investors, like they think real estate, they kind of read the cereal box and like, yeah, real estate tax advantages, right? But that doesn't help them if they're not a damn real estate professional, right? So that's important to know.
So let's go back to, the kind of thinking that you had to go through where you were deciding if you were going to invest passively as an LP, or, you decided to go the active route and, pursue the deals on the GP side. If people are trying to decide, hey, I've got a pretty solid W-2 track and career and earnings, and it's probably going to continue to grow over time, you could be an LP and invest in deals. Or some people might think, I might want to be active and I want to go and take down a multifamily building or another larger asset. How should they kind of think about which one of those two routes is going to be right for them? Because I think the active versus passive discussion doesn't get talked about enough. And people just talk about real estate investing as this broad thing. And you really do have to think about whether you want to be active or passive. And some people are actually capable of going and taking down, two, three, four larger commercial deals while they still have their job. And they can kind of do both for a little while. And they might have to consider, where's that jumping off point? So, you know, people have these different options for these paths. Kind of curious how you would recommend people think about it since you went through it yourself.
Yeah, well, I would say the first thing is never listen to a multifamily guru who's trying to sell you a $50,000 program, because they'll always tell you that you're amazing and you can do it.
That's true.
um, I mean, I mean, I don't want to name names and I don't want to upset anybody out there because it is a rather small ecosystem. But I will say that people who kind of are in these types of programs, the failure rate is actually very, very high. I would probably say I've only seen maybe like 1 to 3% of people be successful.
So taking some kind of like course from someone that says, I'll teach you how to do multifamily, like on the active side, and then they go do it, you're saying that type of
Well,
situation.
the courses are garbage. That's not going to tell you anything. I mean, like, we can teach you how to underwrite and email brokers, but like, I'm talking about the full on like coaching packages and in person stuff. Like, I mean, the
One to
problem
three
is like
percent.
the problem is getting the deal right. Because think about this way, like the brokers control deals in this world. And first off, if your multifamily guru is like telling you that you can write yellow letters to people who have LLCs and these apartment properties, you are wrong. Like, this is not wholesaling houses to people who can barely read. These are like, some they might be like not the smartest of people or rich people, but they're not dummies. They know that they need to sell their property through a broker. um, so that's a red flag. So there's a lot of gurus that kind of think that multifamily investing in like 50 unit to 100 unit, you can do the yellow letters and it kind of you can run it like a wholesaling house flipping shop. No, not the case. Um,
Historically, what's been your best source of lead generation for finding multifamily deals that you've done that have worked out?
well, okay, so maybe I'm a little skewed, because like when we do deals, we don't want to go into deals that are like less than 80% occupied, right? Like we want to be into semi-stabilized, stabilized property. So I suppose if you're looking for garbage properties, you could yellow letter that stuff because there's a reason why that property is dilapidated, but that is a huge, huge risk. Um, Not for everybody, for sure. Maybe not right for the person who hasn't done a dozen deals yet, right? But again, like I think you mentioned this earlier, like, just for single family homes, right? People doing out of state remote landlording and remote flipping. For some people, they get lucky and they get, but you see selection bias, right? Like you see the successes, right? You don't see all the people who strike out and fail. Is all I'm saying.
Right. I was
But
just curious, like, the deals that you have acquired that worked out well, like, what's been the number one source of you finding those deals? It's not direct mail.
100% is
Has it been,
brokers.
I was going to guess broker
Yeah, I
relationships
mean, even if you
after
do
they
get
know
it
you're
off,
serious?
even if you do get it off market, which is always a kind of a white lie, people always say, "Oh, it's off market." No, nothing's off market.
Got it.
It just goes through brokers, and then the broker kind of cherry picks you as the suitor, the winner of it,
Right.
because they know you're qualified. And it goes back to the psychology. It's like the brokers, the only thing the brokers want, they don't really necessarily care if the property sells for 25 million or 26 million. They just care that the thing closes, they can get their commission checks, they can move on. So
Yeah.
what they're looking for is the most qualified buyer who's actually done something and closed before. So this is the hardest part, is your first like half a dozen deals. Um, and this is why for us, like once we got in over a billion in 2020, like, I mean, part of that was the pandemic, right? A lot of people just sat on the sidelines too, but we just got fed a lot of deal flow in 2020 because we kind of hit that wave, right? We're, you know, these guys are hot. We got to keep feeding the fan at this point. But getting up to that point, you could spend like 2 to 4 years just getting a bunch of garbage from these brokers, even though you can probably call them friends. They're not going to send you anything.
Where would
Like
you say
it's
that we are in the multifamily cycle, and in terms of like, you know, the scalability of it, the difficulty, the profitability of it? Um, I've been hearing that there might be a pretty meaningful 20% gap between the what sellers are expecting, what buyers are willing and able to pay for it to cash flow. I don't know if in your experience what that looks like, or if that gap is there, if seller expectations have come down at all. But I would just, you know, the last question we have for you is just curious what your
Yeah, I
take
wouldn't
is
really
on where
call
we
it
are in
a
multifamily.
gap. I would just call it more like what are you buying it based off of where the peaks were, and you're like 30% lower. So from that perspective, the basis is really good, and this is actually, you would think that this is a good time to buy. Um, I do think that there's been some stabilization. We've seen some appraisals come back much higher than it was 2 years ago. So I do think we've kind of seen stabilization in prices from this point
Hmm.
on. Um, but it's hard, right? Because you're going, even though everything is cheaper, the debt terms are still horrible. They're absolutely horrible in comparison to what it was. So people can only pay a certain amount. Your taxes and insurance are through the roof. I mean,
Yeah.
insurance came down a little bit, but since the last few years, but it's still through, like the deals just don't pencil, and that's why you're still seeing people like the buyers and sellers, like you said, they're still separated a bit. But if you look at the transaction volume, and a guy could just look up ChatGPT and like transaction volume on the commercial sales side, I mean, in 2021, I think it was like this high, and then the year after it was like a small fraction of that. I do think you're starting to see that transaction volume come up. So I think that
Hmm.
alludes to your earlier reference of that gap, right? I think that gap is closing, but it's, I mean, if you're looking, I mean, it's hard for us to pencil deals these days, like because when you underwrite it with legit numbers, you're you're like negative cash flow or like neutral cash flow, and you're kind of just banking on the cap rates to come down. And what I to give people a specific example, I mean, just looking at something that was fresh in my head this week, like I think it was like a class B, like a 200 unit class B in Dallas, for example. I think they had put the reversion cap rate at 5.1 or 5, yeah, something like that. I think they should have used a 5.5 reversion cap rate.
So
Um,
they're just forcing the numbers to work on paper and hoping it's going to be that way.
yeah, yeah, but I mean, I'm just following like standard underwriting practices. But like on the one hand, I'm kind of like, and this is not investment advice. I'm kind of like, well, chances are, like, I mean, the cap rates will go under four, or 4.75, for example, in the next 5 years, and these guys will get lucky.
Hmm.
Like that's just what the chances are, right? Like, I mean, how much worse can it get, right? And you've already started to see somewhat stabilization in prices. Um, so, so I think what you have the situation. I mean, I know you get a lot of newer general partners out there. Like a lot of the general partners that were around when I started, they're out of business these days. I mean, I can't tell you how many like websites that just don't go to nothing of these syndicators that started
Wow.
a couple of years ago or even in 2020. um, but they're all gone. So from that perspective, it's a great time to get started these days, and the basis is low, right? I mean, at the end of the day, like they say, it's not what you know, what you're going to do to it necessarily, like what you paid for the damn thing. And right now it's low. So that's the key ingredients to a great time to get started and established. But here's the problem, like you never know, right? You never know. Like for all we know, with the Iran war, they could increase, I mean, I think they should increase the interest rates based off that stuff because it is inflationary. So you got to dial up the interest rates, and that will absolutely damper this correction or this recovery. And people will
Yeah,
be,
it
if the
would.
guy
Yeah.
who underwrote that Dallas deal at 5.1 reversion cap, he's screwed. He's absolutely screwed. The investors won't know about it until 4 years later, but they're screwed. Um, and there's been guys who bought in 2023 and 2024 when the market didn't quite correct. Like they're gambling on the cap rates to come back down. And you know, if you play Texas Hold'em, right, and like you get like a good pocket aces, yeah, you press that, right? I wouldn't say that these odds are as strong as that, but like you have a kind of a good hand here. The problem is like it's hard to kind of play this game like Texas Hold'em, right, where you have iterations and you can kind of take these risks, these like predictable rates risks with this stuff. This is like people's livelihoods and money on this is real money and blood, sweat, and tears on the line. But if you were to have, an infinite amount of money, you would kind of put down some early chips at this stage to play the game. But um, yeah, you just don't know, right? But the problem is like when you do know, like when Phoenix is finally going up for rent increases 2 years in a row, which will probably happen, let's call it 4 years from now, you're not buying at a 30% discount. You're buying it at a 10% discount. So you missed out on that 20% delta, which people say, it's 20%, whatever. And I'll pay a little bit more. Remember, when you are leveraging real estate in these deals, 20% differential in pricing means that's the difference between you getting a 3x equity multiplier and a 2x equity multiplier. It is huge, absolutely huge. I mean, this is where, like, when I got started in 2016, people were getting like crazy returns, like 300%, because the cap rates were kind of steadily coming down by a tenth of a percent at least every year.
Yeah, that's really interesting. I appreciate your perspective on what the market has been like historically, what it's been like today, and we have an upcoming interview pretty soon with Brian Burke, who has been really well known in the multifamily space for a long time. And he pivoted. He didn't acquire any deals for several years. And I don't know if he's still holding any of his multifamily or not. I'll have to ask him. But he pivoted, I believe, to senior living. And, we'll be talking about how he kind of changed course. But I have interviewed a bunch of multifamily investors on the GP side so far who are still pressing forward, still acquiring deals. And so, it sounds like it's challenging, but some of these guys are still finding deals and still making it happen somehow.
Well, you can close whatever deals you want, right? But like what I want to do is I want to see what you're using for your underwriting and your comps.
Yeah, it'd be interesting to really look at all of these, right?
Yeah, that's the part of it nobody's talking about.
Yeah, that's really interesting. Like we can't really see their spreadsheets of what they underwrote. Maybe we could get them to share with us probably within the mastermind community. We're going to have deal reviews. So we actually will have some of these of like pulling back the curtains and what are people's assumptions in these deals and getting smarter at knowing are these reasonable assumptions or not. And
Yeah, but there's a problem with that too, because for like, even intermediate level people with underwriting, they know, check the reversion cap rate, check the rent increases per year, but it's a cat and mouse game. Like they like one of the games that people would do to get it around the coaches so that the deal passed muster is to just inflate the other income category.
mm,
And then that's the way you can show a very conservative reversion cap rate and rent increases per year and occupancy, but you still inflate the deal. So I think the thing is, like, I don't want your guys' spreadsheets. I want the raw financials, and let me just like underwrite this thing from square one, from the beginning.
it
And this is, again, I didn't make this up. Like, I'm just copying. Like in my book, The Wealth Elevator, we talk about these different stages of the wealth building game, right? Like what I'm talking about is on the third floor of the wealth elevator. Like once you've hit 2 to 4 million net worth, you start to be, you're not a general partner. You're a capital allocator. and you're a family office. And how do the family office do things? Well, they have a professional underwriter on their team. They have a CIO, or you could kind of emulate this on your own. This is kind of what we do, right? Like we pull in all these deals from people we like, and I'll tell you, it's not all the people talk about on podcasts and stuff. Like you talk to anybody in the industry, they're like, "Who's that guy? Oh, he runs the biggest multifamily, blah blah blah." Like I haven't heard about that guy ever in my life. He's just like a REI like celebrity, but he's really not that sophisticated or not. He's really not that well known in the true industry. And when you kind of, but the key is to find this world where these guys don't want to work with retail investors putting in $50,000, $100,000 chunks. These are the more quality operators and deals out there. But if you can kind of tap into that deal flow source, and then of course then you underwrite the deal on your own as a family office. And then on this level, if you kind of think about it, it's a lot more, I want to say gentleman's game or whatever, but it's a little bit more sophisticated. Like these guys know that people, they don't want to look at a shiny pitch deck where they have a map where Costco is. They don't care. They want to know like the raw financials, and they know the investor already has access to something like Yardi or CoStar, right? It's already known that you're going to do your own underwriting on it. But the retail investor, like the way it's done on the retail investing side, everything is spoon fed correctly and incorrectly.
That's interesting. I really appreciate these insights that you have to share, based on your over a decade now of experience in real estate investing. So, there's only a small percentage of people that really have that much experience and that can really share these types of insights. So we're really glad that you were able to take some time today to share all of this with us. Where can people learn more about you if they want to connect with you?
Yeah, if you're a credit investor, you can shoot me an email, Lane at thewealthelevator.com, or check out my book, The Wealth Elevator, on Amazon.
Lane, thank you so much. We really appreciate your time today. If today's episode was useful, subscribe so you don't miss what's coming. We drop 2 episodes every week. And if you want to go deeper, join thousands of investors getting our free weekly newsletter at newsletter.launchrei.co or check the link in the show notes. See you next time.